The first policy decision from the Bank of England this year, and as expected, no change on rates or QE. So the base rate being kept on hold at a record low 0.5%, and the bank's bond purchases also on hold at £375 billion. Let's get out now to Philip Shaw. He's Chief Economist at Investec, joining us from the LSE. Well, Philip, no change then. When do you think we will see change in BoE policy?
Yeah, no changes today, no surprises. We are not convinced that we are going to see the MPC supply any further QE. We do think that although there is a little bit of bad news in the economy at the moment, actually the picture is a little bit more mixed, and we're mildly optimistic that the funding for lending scheme will result in flows of credit to the private sector, and therefore we'll have some increasing signs of better rates of private sector activity through the course of the year.
Just to be clear then, you think that's the bank done with QE?
Well, on balance, yes. I mean, clearly, if we have an adverse shock to the economy, then one way of trying to push some stimulus through to the economy would be by undertaking further QE. But on a central case basis, that yes, we do think that the bank is probably done on QE, bearing in mind also that we think that inflation is likely to rise probably about above 3% over the course of the middle of this year, which is a further disincentive.
If the bank is finished on its QE, and as you say, we've got the funding for lending scheme, we're still waiting to see the effects of that, but that's not going to be changed anytime soon. If the economy does deteriorate, what options are left to the bank?
Well, there's been some talk about perhaps QE not being as effective as previously, but the balance of opinion, certainly within the MPC, seems to be that QE is still a major instrument and probably the tool of choice to be used by the central bank to try and get the economy going again if need be. Other than that, obviously we do have the funding for lending scheme, and there are other government schemes. Perhaps the Bank for Business is one way that credit flows could be pushed through to the private sector as well.
OK, now last week we had a note from Citi's UK economists saying they were putting back their first rate hike expectation to mid-2017. That's some distance in the future. I presume you're not quite as bearish on the UK economy as that. When do you think the bank will raise its rates first?
Well, that's right. I think if you're waiting until 2017 for the first rate hike, implicitly you're pricing in a very, very soggy 3 or 4 years for the UK economy. We're a little bit more upbeat than that. We think that perhaps in the second half of next year, i.e. 2014, the MPC will be sufficiently optimistic about the outlook for 2015 and 2016 to say, right, OK, it's time to get rates away from very near zero levels. But even so, I think by historical standards, that interest rates are likely to remain low for quite some time to come.
OK, Philip, just to finish up, let's get a market reaction. Cable is little changed at around 160.55. There has been move today, though, in the inflation-linked market. The 10-year inflation-linked yield hitting a record low, minus 0.97%. Now, that was after an unexpected no change to a measure of inflation, the retail price index inflation. Just tell us why that's important and why those yields have fallen to these all-time lows.
Well, OK, well, this morning, this announcement by the ONS follows a consultation on whether it should change the way that the RPI, the Retail Prices Index, is put together. Technically, it's pretty well known that the method, the Carley method that the ONS uses to compile the RPI is flawed. It overstates inflation, and it also fails a key test called the reversibility test. Now, because of this, it had been widely expected that the ONS would announce that there would be a major change to the compilation of the RPI. When that didn't arrive, what you saw was a big rebound in the value of index-linked gilts. In terms of the wider economy, what does this mean? Well, I think if there had been a change to the RPI, then anybody receiving an RPI-linked pension would have been slightly worse off. And there would have been implications for pension funds as well, not just because they hold our index-linked stock, but also because that their liabilities are partly priced off RPI-linked salary increases. So there could have been some implications there in terms of pension deficits probably closing in the majority of cases, with knock-on implications there for corporate earnings. But in the end event, it didn't happen, and what we're seeing is a big fall in index-linked gilt yields. OK,
Philip, thank you very much. And I think actually we now have 8 measures of UK inflation. Staying in the UK, it's been a big day for retailers. Let's start with Tesco, the world's 3rd biggest retailer, reporting its strongest sales growth in Britain for 3 years. Its shares rising more than 2% on that news, taking it to its highest level in a year. But Marks & Spencer's, on the other hand, the biggest loser on the FTSE 100 earlier today, at one point down more than 4%. The retailer said sales of clothing, footwear and homeware fell more than expected in the 13 weeks to December 29th. And finally, more evidence for those who say the worst of the Eurozone crisis is over. Spain sold €5.8 billion of bonds at auction, well above its initial target. Borrowing costs fell and demand was strong. After the sale, the 10-year yield fell below 5% for the first time since March last year. And that's what's moving on markets today. See you again tomorrow at the same time for Market Pulse. I'm Jamie McGeever. This is Reuters.